Let's get right to our floor show with Natixis Investment Manager's lead portfolio strategist, Jack Janasiewicz. Jack, great to see you. Obviously, all eyes tomorrow on the CPI. What are you expecting? I guess if it comes in hotter than expected, then that's probably going to hurt the markets, right?
Yeah, I think that's going to be the key determinant here for market direction, right? It's going to be the CPI print on tomorrow. And then fast forward, you can look out to the NVIDIA earnings a week from tomorrow. But in the interim, if we get something in line with what the market's expecting, which is 0.3%, I think in line or even softer than that, I think that'll sort of put the market on good footing here. And I wouldn't be surprised if we continue to grind higher as rates push lower on the back of that.
Jack, you point out, and it's interesting, you say that if it wasn't for shelter, medical care costs, and auto insurance, the actual inflation rate, you take those out, is pretty close to the Fed's 2% goal. But of course, the Fed can do nothing to stop inflation in those areas, right?
And that's the key thing to think about here, right? I mean, a lot of people are concerned about the stickiness of inflation in those three individual line items that you just highlighted there. Those really aren't demand-driven issues that we're talking about. And so if the Fed is going to try to really work through some of that stickiness via increasing rates further from here, you're probably not going to see much happen, and the collateral damage to the broader economy probably shows up in the labor market. And that's probably something the Fed is loath to do, given that they have both the dual mandate, full employment, and price stability. So right now, they're just simply trying to buy time, and that's, I think, the higher for longer mantra that they've been sticking with.
Yeah, but you know what? The markets have performed pretty well at these higher level of rates. You say the rate level's not really as important as how much risk appetite is out there. So that's my question. Is there appetite for risk?
And if you look at the backdrop that we're seeing right now, I think there is room for risk to be added in here. And why is that? Well, we still have relatively strong growth. And more importantly, that modest inflation, as long as it's heading in the right direction and maybe going to that 2% target a little bit slower than some people would like, but that gives a little bit of pricing power to corporate America. And so, when we start to think about what drives the equity market here, and more importantly, risk appetite, it's the earnings cycle. And that modest growth and inflation heading down, that puts a pretty good backdrop together for a sweet spot. And that's really where the earnings come in. And that's what's driving the market in here.
Just very quickly before we have to go, Jack, what about the consumer? We were led to believe the credit card debt was starting to pile up, delinquencies on mortgages were showing an upward shift. How would you describe the state of the consumer right now?
Yeah, it's a very segmented market, I think, and you're seeing signs of that from some of the announcements that we're hearing here as we wrap up first quarter earnings from companies like McDonald's, Yum Brands, Starbucks. They're certainly seeing evidence of a more discerning consumer, and I think some of the portions that we're seeing a little bit of that stress really hit is the lower income band of the consumer, so to speak. And what's interesting, though, while certainly it's not something we like to see the pinch happen for that lower income bucket, but the key here, when you look at their aggregate total consumption, it really is a small portion of the big pie. So, yes, the smaller or the lower income buckets are being pinched a little bit in here, but the bigger driver of that total consumption backdrop is still the upper income bands, and those are still relatively healthy.
Very good. We'll leave it there. Actually, on an optimistic note, I would say. Jack Janasiewicz. Jack, thank you so much. Appreciate your time this afternoon. Okay, let's move on here. For more on the investment landscape, let's get right to Stifel CEO, Ronald Kruszewski. Great to have you here, sir. You're live in Las Vegas, you lucky devil, where Stifel is currently hosting its Blueprint conference. If you're going to hold a conference, I guess that's the place to do it. Stifel, by the way, the seventh largest retail brokerage in the country. So I guess, Ron, my first question is, how's business right now?
Business has been very good. Our wealth management business. Yeah. I just talked this morning. We celebrated like our 25th consecutive year of record revenue. Business is good. And here at Blueprint, we're talking about what you're talking about. We're talking about AI. We're talking about the economy. We're talking about interest rates. And so our clients are engaged and business is good, and our institutional business is picking up.
So talking about interest rates, we're also data dependent on inflation. Tomorrow we get the CPI. But as I just said to Jack in the last interview, we've done pretty well at this higher level. Even if the Fed decides, we're not going to cut this year, it seems like the economy, and the markets in particular continue to hum along?
Well, absolutely. Well, first of all, I'm going to just say that at Stifel, we've been saying since the beginning of the year, we never thought there would be 7 rate cuts. I said in January that there might be 2, and today I'm going to say that there aren't going to be any, because inflation is going to be more sticky than people think. Core PCE is going to be around 3%, and the Fed's not going to be cutting into this environment. But, that said, look, in the history of time, interest rates aren't that high. This is what they used to be. We just got so used to zero rate interest, zero bound interest rates. We forget that a 10-year at 4.5, that's normal. Yeah. And this economy is doing just fine.
Yeah, people got used to cheap money for a long, long time, and it's still relatively cheap when you look in history. Too long, yeah. Many people would agree with that. You mentioned AI earlier, Ron. I mean, look, it's the buzzword. It seems like every day we talk about new products coming out. Is that what you're hearing from your clients? They want a piece of the action?
They not only want a piece of the action, but a lot of our advisors at Stifel and our clients, they want to know how AI can make them more productive. It's like the personal computer in 1981. It's a new tool. It's going to make people tremendously more productive. I'm always amused a little bit about people saying they're going to use AI to only work 3 days a week. Here at Stifel, we're talking about using AI to get 2 weeks of work done in 1 week. Because we got to serve clients here, but it's a hot topic, and one that not only from making yourself more productive, but what a place to invest. And our clients want to talk about AI.
What's interesting, Ron, is that certainly with the capital markets, there's been so much cash on the sidelines. People kind of waiting. I'm not sure for what. And then as you see the market going up and up, it's a hard time. They have a hard time jumping in. But are you seeing more people putting cash to work?
We do. But let me throw a little cautionary message here, okay? And that is that the market has been continuing to have a million reasons that we need to cut rates, to have a soft landing, and whatever. I have to tell you that as I look at the market today and for the next few months, I see downside. I actually think we're getting a correction in this market, because it is going to dawn on the market that we are not straight up, that interest rates will stay higher for longer, and that the market will re-rate to that. This market has still been thinking that we'll get 2 to 3 rate cuts this year. That's not going to happen. And when it comes to that realization, it might be tomorrow when you see where CPI comes in. But our belief is that today the market is pretty fully valued for these economics, and we actually see a little risk to the downside.
It's funny you should say that, Ron. We've had a number of guests say, look, these markets are frothy. They're being complacent, and a correction, whether it be 5, even 10%, is actually not a bad thing. And from what I hear from you, you agree with that.
Well, I do agree with that, but I also think it's an opportunity to buy some great stocks. It's just markets just don't go straight up. You have to look at what the consensus sentiment is, and the consensus has been that rates are going to be cut. And when it figures out it's not, you're then going to have an opportunity to add some great companies just at a little bit better valuations than we're seeing today. Very good. Well, enjoy your time in Vegas. I'm sure everyone there is. Ron, thank you so much. Yeah. It's great to be here. Nice 100 degrees here in Vegas, and we're having a good time. Thanks for having me on the show, all right? It's our absolute pleasure, and enjoy the air conditioning. Ron Khrushchevsky from Vegas. Thank you.